Welcome back to the NEOS Monthly Income Podcast, where we focus on the importance of maintaining a healthy monthly tax-efficient income. And as always, we're joined by the founders of NEOS, Garrett Paolella and Troy Cates. Gentlemen, happy holidays.
You too, Tom. Great to see you both.
Happy holidays. Good to see everyone.
Yeah, happy holidays. So it's amazing that 2025 is coming to an end. It's a busy time of year for investors, for advisors. Garrett, maybe start with you. What should advisors and investors be focusing on as we approach the new year?
Yeah, so we've been talking this whole year really around durability of portfolios, right? Asset allocation, diversification, of course, with our products, ways to play volatility as an asset class. And so I think that's still our top of mind and focus as we head into 2026. And what we're hearing from investors, their clients, is just saying, listen, we have several spats of volatility this year. How do you play that to advantage? What's going on with lowering interest rates? And I think at the end of the day, what it all comes down to is how to build and construct that kind of durability in the portfolio to have cash flow when you need it, upside appreciation, when markets are doing well, but also know that there's that nest egg or that bucket that can be utilized, when markets do have more challenging times and are negative on a month, because as we know, not everything always goes up and to the right, every single month and every single day.
Yeah, you're dead on right. And Troy, you guys are talking to advisors all the time. What are some things that advisors are most interested in as we approach year end? They talk about portfolio construction, they look at the economy, they're meeting with clients. What are some things that are resonating most strongly with you?
I think the advisors that I've been talking to have been looking over the past year and thinking about exactly what Garrett was saying, thinking about the volatility we saw, how aggressive some of that volatility in the equity market sell-off was, say, in April, and thinking about how they need to plan for 26 and what they need to do next year to maybe lower their clients' overall portfolio volatility, and thinking about some of the products out there that can do that. A lot of them are also looking at year end, thinking about taxes, what they need to do for their clients and how they need to position them going into the new year, and thinking about building those, as Garrett was saying, those durable portfolios that'll help them kind of weather some of those more volatile periods that we know will probably be back next year. We see this over the past year, so we're expecting a little bit more volatility next year as we've seen this year, and going from there.
Investors and advisors are embracing this kind of lower rate environment as we go into 26. We're expecting a couple cuts. How do you look at it from Neos's standpoint? Are there advantages to that in your product offering?
So there are advantages in our product offering for lower interest rates, right? We're always looking on whether that's our fixed income products, we're enhancing the income. So the whole concept is how do you generate income above and beyond what you might get out of like our core fixed income product or our 1 to 3 month treasury bill product, CSHI. And so I think as you look at lower rates, there's opportunities, there's funds out there, right? Similar to Neos and what we do, to be able to continue to enhance that income above and beyond where interest rates, have now been over the last few years, and other ways to play other asset classes as well to get income from other areas of your portfolio, such as like our equity high income, where you tend to be long equities and those only pay you maybe 1% in a dividend yield. Well, some of our equity high income products are more in that 12 to 15% range. And so adding in a layer of that, really can aid to the overall portfolio income. And so that's been a big conversation of like what's going to happen next year, with interest rates and as they come down, how to adjust that within, client portfolios.
Troy, tax loss harvesting is always something that we talk about at the end of the year, a big thing that advisors focus on and self-directed investors. Tax loss harvesting is really a part of your strategy at Neos as well. Talk a little bit about that and what might that bring. I know you don't have a crystal ball. We don't have final numbers for 25, but there's still some great advantages there.
Yeah, it's something we always talk about is the tax efficiency behind our products and what we're trying to bring out, and thinking about how we could bring out a tax efficient distribution and what your 1099 will look like at the end of the year. So harvesting losses is an important part of that structure, and it's really not so much based on the equity or fixed income portfolios. It's really around the option trading and what we're doing there, whether it's on a monthly basis or a weekly basis in some of our products. And it's important to look at that. And especially as you start to look into this space, this option income space, and what the net after tax distribution looks like for an individual shareholder. Sometimes they're looking at just what the gross number might look like and thinking, okay, I'm going to get this distribution. Great. I could do X, Y, and Z with it or reinvest it. And when it comes down to it, that tax efficiency is a very important part of it. So understanding that, and yes, come the end of January when the tax numbers are done and those are all sent out to all the different brokerage firms and everybody could see what their 1099 looks like for 25, they'll have a better idea of what that looks like. But it's something that Garrett and I really focus on as we build these products and bring these products out.
Well, Gary, you guys have been really busy this year, not just building the business, but launching new products. And December's not been an exception. Talk a little bit about the new Ethereum high income ETF. And most importantly, it came out at a really cool time when we saw a pullback in crypto.
Yeah, we're really excited. So the Neos Ethereum High Income ETF, ticker is NEHI. We're excited about this one. It's a follow-on to our existing crypto suite, which right now has BTC, our Bitcoin High Income. And really, this is coming out of demand. A lot of investors have reached out to us saying, I own more of a diversified, crypto portfolio, and Ethereum really is the next largest opportunity to invest in. And so we spent this time, I think, as most people know, we're very institutional focused within what Neos delivers on our investment process. And so this wasn't something we could just throw out earlier this year. But because of the growth and the evolution of the digital asset space and the regulatory environment, we've had the ability to ultimately get an Ethereum product down to the market, do it under the institutional prowess of what we like to do. And so we're really excited to offer that option, for investors to choose their Ethereum exposure. But I mean, Ethereum is incredibly high volatility, even higher than Bitcoin. So you could harness part of that as an income source, which is just a great allocation within the portfolio as you think about like that digital asset sleeve.
And Troy, kind of following up on the volatility that Garrett was talking about, I don't mean to nerd out here, but explain specifically how volatility works to produce more income.
We always love when you nerd out, Tom. So feel free on this podcast. But when you're thinking about volatility, if you give back to April as an example, we saw this equity sell off in the market and we saw this spike in volatility. And what that does to the option market is it allows us to bring in additional income, or in some cases for our products, write on less of the notional of the portfolio and further out of the money, which gives us potentially more upside appreciation if the market does move higher. So volatility for us in our products is not something that we shy away from or, don't want to think about. It's very important to how these products work. You think about the Ethereum product that Garrett was just talking about, our new ETF, volatility in Ethereum is even higher than it is in Bitcoin, in most scenarios. So it's something that could really harness. And, when you're thinking about bringing in income or sourcing income off the volatility of an underlying reference asset, whether it's Bitcoin, Ethereum, the NASDAQ 100, the S&P 500, it's just a different way to bring in income into your portfolio versus traditionally you were always looking at just your fixed income portfolios or potentially just dividends coming off equities.
Thank you. And Garrett, new to the lineup, the long short equity income ETF. First of all, talk about that because there might be some Neo shareholders that aren't as familiar with long short strategies.
Yeah, so this one's going to be pretty unique in the market. There's really not a lot of equity long short products, but this is also going to be one of the first of its kind that also has an income stream. I think as our viewers know, we're all about income and how to do that in tax efficient manners, but give you different underlying exposures. And so for this product, the ticker is going to be NLSI for Neos Long Short Income. But we're excited. This is going to be a portfolio of long short equities. And I think for people that have not invested in those types of portfolios before, you essentially build a portfolio that's long equities, like you would normally buy with hoping for a price appreciation. But then you can also own a portfolio of short securities. You're going to sell short a portfolio of equities that you think the price is going to decelerate or go down. And so when you build a long short portfolio, the combination ends up giving you either a hedged or this net long short exposure. And why is that important is as you think about two ways for the portfolio to make money, long term, trending upward parts of the equity market, your long portfolio is going to perform and your short is either going to be a hedge or a risk reduction for the times the market pulls back, but also the ability with long short portfolios is if you pick equities that you think are going to actually go down because of decelerating earnings or some other type of slowdown within that one specific company, you have the ability to actually profit from those equities going lower, those companies' stock prices selling off. And so what you end up getting is kind of a nice hedged equity exposure that's really around equity selection, so company selection. We do that, of course, as everybody knows, all quantitatively driven. And then for us in this, because we're having an income-based product, we're also going to be generating income from selling long short options. We're going to use those that are linked to the S&P 500. So it's got a kind of core correlation of where our original equities are being selected from. But that option strategy helps deliver that tax efficient income like we do in so many other products that we offer. And so now you're getting a portfolio of long short equities looking to produce, manage the volatility, right, in the total return, and then enhancing the income capabilities with the option overlay. And so we're excited about that one. We have had a lot of interest from investors that historically have invested maybe in hedge funds, right? A long short equity strategy is very much an institutionalized strategy that's been utilized in hedge funds going back to early the 70s and 80s as some of the first hedge funds. We're just, again, trying to bring that institutional prowess, those types of investment strategies to all investors. And so we're excited to bring, NLSI out to the markets.
When you think about long short, and also you kind of hinted that you wouldn't be surprised if we saw some bumps in the road in the market in 26. Where would this new strategy fit and what would you maybe expect from that?
I think this new strategy fits into a more conservative portfolio, thinking about how some of our products are hedged. While this isn't an exact hedge, using an option strategy to hedge out some of the downside, it is looking to smoothen out the return profile. As Garrett walked through, you're going to have this portfolio of long names that we're looking to appreciate over time, and we're holding for a longer period in most cases. And then you have this portfolio of short names that'll be traded more frequently to capture any gains from the short positions and hopefully seeing those move a little lower and capturing some of those gains and locking those in on top of that with the option portfolio. So while it is a more complex strategy for most investors to understand, as Garrett was walking through, it's a strategy that's a lot of hedge funds and more institutional funds have used for a long time. And I think bringing it out in the ETF format and being able to look at that and have the transparency in it on a daily basis and be able to understand, okay, the portfolio is this long these names, it's short these names, and understanding why it's looking at that way on a nightly basis and then seeing what options are in there. I think it gives investors a really good insight into what the portfolio is doing and what they're investing in.
Garrett, as we're wrapping up the year, you guys aren't resting. You still have some more in the pipeline. Maybe give us a little hint about what other products we might expect.
Yeah, we're always excited about innovation here and always meeting investors where they are and what they're looking for. And as we know, everybody's portfolios are unique and different. Coming out soon is going to be a MLP and energy transition, high income. And so kind of that MLP exposure, energy exposure, and ability to generate a high amount of income from that option overlay strategy. So excited about that one. And then also we have a whole suite of boosted products which is going to be new to the market because we do things, of course, always a little bit different than everybody else. But for those investors that are looking for a little bit more risk, a little bit more total return, meaning, of course, a little bit more income, we're going to be enhancing what is products linked to the SPYI, so our S&P 500 high income, QQQI, our NASDAQ 100 high income, and BTCI, our Bitcoin high income. It's going to be strategies similar to those, but with boosted. Boosted really means a degree of leverage, that we can take to ultimately add to the overall total return and income. So as you think about that equity suite for us that we've been talking about, you'll have a boosted version, you'll have a regular core version, or you'll have a hedged version. And so investors can choose their risk to return appetite or shift through, the three based on, changing market dynamics, and their overall portfolio needs. So really excited about continued products to come out and always meet investors where they are.
Well, gentlemen, thank you. This has been a blast. I can't believe we got 12 episodes in this year. I'm looking forward to next year. We've got a lot to be thankful for, and I know you guys don't take it for granted. There's a very loyal group of advisors and a group of individual investors who have been so committed and loyal to Neos. And I know we all want to thank you guys for all your stewardship over the last year.
Yeah, absolutely. We couldn't be here without the trust and the opportunity for all of our investors, which we view as our partners. So we appreciate everything that they've done, and trusting us. And we always promise to keep our heads down and keep pushing hard.
Thank you both and happy holidays.